Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
Okay, so let's focus today on the pretty high-stakes financial tension that's building around CSCO Systems. Ticker is CSCO. Just to set the stage, the stock closed at $78.42 on December 19th. Now, that price is defined by this really sharp retracement right after the stock hit a multi-decade peak, a huge psychological level of $80.25 on December 10th. The volume around that peak was, well, it was massive, suggesting a really profound institutional event. So I guess the question we really have to ask is simple. Was that push above $80 a legitimate fundamental re-rating, driven by their pivot into AI infrastructure? Or was the collapse that followed just the signal of a classic bull trap? I'm going to argue that the AI order pipeline we're seeing fundamentally validates this new valuation, and $80 is just temporary resistance.
See, I fundamentally disagree with that entire framing. That move to $80.25 was, if you look at any of the microstructure metrics, it was basically engineered to provide exit liquidity. It was the precise moment that institutional capital decided, okay, we're out. All the immediate trading signals confirm heavy distribution, not bullish conviction. And that suggests the stock has hit a very, very hard supply-driven ceiling. The real story here, I think, is how this undeniable fundamental success, the whole AI narrative, is being completely overridden by critical execution risks and some very sophisticated market skepticism. It's a definitive inflection point.
Well, my position is that the market is finally, and I'd say correctly, recognizing CSCO's actual structural importance in this whole hyperscale AI build-out. For years, the narrative was that CSCO was, irrelevant in the cloud data center. But the evidence is now just overwhelming. Management has confirmed that AI infrastructure orders from their major web-scale customers crossed $2 billion in fiscal 25, and they're projected to exceed $3 billion in fiscal 2026. To put that in perspective, this is a verifiable massive growth catalyst. It completely validates the broadening of the AI trade. It's shifting focus beyond just GPUs, NVIDIA's whole domain, and into the essential high-performance plumbing you need to connect all those massive GPU clusters. We're talking about Cisco's Silicon One high-speed Ethernet fabrics.
And of course, this triggered a justified wave of analyst upgrades, including Morgan Stanley raising their price target all the way up to $91.
That $3 billion pipeline number, okay, it's impressive, I'll grant you that, but it served a dual purpose. It wasn't just validation. It provided the perfect narrative cover and, more importantly, the necessary liquidity for institutions that were just waiting to exit positions they've held for, what, a decade? To understand what really happened at that $80.25 peak, we have to look at the dark pool activity. The highest off-exchange short volume ratio we saw in December 2025, a staggering 54.76%, it coincided exactly with the $80.25 high on December 10th. Now, for context, this ratio tracks the percentage of short volume that's executed away from public exchanges, in these dark pools. A ratio that's consistently over 50% for a stock of this size, that is a signature of institutional distribution. It tells us that the smart money was actively selling into that bullish catalyst, using all that enthusiasm to just efficiently liquidate their long positions without crashing the public price.
I see why you're emphasizing that elevated off-exchange activity. But I think the conclusion that it's purely bearish institutional conviction is, well, it's a bit simplistic, especially for a stock like Cisco. Let me offer a different perspective. In these mega caps that see huge non-discretionary passive index fund flows and, frankly, aggressive retail participation, high dark pool activity can often just represent market makers hedging against that immense buying pressure. They're just trying to minimize market impact or slippage while they're filling these huge orders they're forced to execute. And look, if the intention was purely to distribute and slam the price down, we should see an immediate vulnerability to short squeeze, but the actual short interest is pretty low. It's what, 1.3%? The trading mechanics are more complex. I think we should look at days to cover, which for Cisco is sitting at 4.18 days.
Okay, but that 4.18 days, which, measures how long it would take shorts to cover, I don't think it supports your hedging thesis at all. I'm just not convinced by that line of reasoning, because when we compare apples to apples in the sector, the divergence is, it's stark. You said market maker activity is universal. If that's true, why does Arista Networks, a direct high-growth competitor, have an off-exchange short ratio down around 36–37%? The fact that Cisco's is hovering near or above 50% confirms this is company-specific activity. It is not generalized hedging. It indicates deliberate, active resistance against CSCO's price momentum right around that $80 mark. And the institutional intent to cap the price is further confirmed by insider behavior. Director Michael Capelleus executed 2 significant sales right after the high, $1.25 million on December 18th and another $0.84 million on the 19th. These are well-timed, high-value sales that signal that even the most informed people lacked any conviction in a sustained breakout.
Insider selling, come on, particularly for tax purposes or just routine portfolio rebalancing, is really common. It doesn't necessarily negate a fundamental re-rating. We need to focus on what drives long-term value here. The technological shift, the adoption of Cisco Silicon One across hyperscale data centers, this is their custom chip for high-performance switching, is essential. It positions them to capture the market for these massive Ethernet fabrics that are rapidly replacing InfiniBand in large AI clusters. This transition is structural, and that $3 billion pipeline confirms the demand. The technical selling you're seeing is probably just rotation out of old capital structures and into new growth-oriented ones. Using the high as a chance to clean up the books.
Before we just accept that cleaning up the books narrative, those insider sales get a whole lot more context. When you view them against the simultaneous emergence of the security overhang I mentioned earlier, this Aqua Shell zero-day vulnerability, this lack of conviction is completely justified by the catastrophic security liabilities it introduces. And we have to pivot back to the fundamental challenge Aqua Shell presents. The flaw, CVE 2025-20393, allows an unauthenticated attacker to execute commands with root privileges. It's been assigned the maximum possible severity score, a CVSS score of 10.0.
And just to clarify for anyone who might not be familiar with that scale, a CVSS score of 10.0 means this is an exploit that needs absolutely no credentials, it can be done remotely, and it grants total control over the system. It's literally the worst-case scenario.
Exactly. And this isn't some theoretical risk. The vulnerability was being actively exploited by UAT 9686, a confirmed China Nexus espionage group. So here you have a company that just spent $28 billion to acquire Splunk to bolster its security segment, basing its future growth on integrated security and zero trust. When a core product line is being actively exploited by a state-sponsored actor to get root access, well, it fundamentally undermines that entire very expensive value proposition. This event threatens high-value government and enterprise contracts that rely on Cisco security, and it's making institutional investors really nervous about the long-term viability of that security revenue growth.
Okay, look, I acknowledge the severity of the Aqua Shell flaw. It's a major operational challenge, and a CVSS 10.0 has to be managed with extreme urgency. I get it. However, we have to contextualize this against the company's vast business breadth and its historical financial strength. This is not a fragile startup. Cisco has a massive, diverse revenue stream. We're talking about a company whose sheer resiliency and solvency are frankly unquestioned. They have never had to do a reverse stock split, unlike so many of their failed dot-com peers like Nortel or Lucent. That historical strength means they have the balance sheet and the organizational maturity to absorb and mitigate these types of risks without a systemic failure. And while the incident is damaging, the initial market reaction was pretty muted. The stock dropped, only about 2% after the CISA announcement? That suggests that institutional investors who know the remediation plans and the scope, they view it as a manageable operational setback, a patch cycle, not a complete unraveling of the business. And crucially, the fundamental security thesis is proving resilient even with these challenges. The security segment still showed 9% growth in Q4 of 25 after the Splunk integration, so the market sees the integration is succeeding and the revenue momentum is strong enough to weather a single, albeit severe, security incident. The structural shift to recurring revenue through Splunk is just a much more powerful financial narrative than a single zero-day.
I think calling a CVSS 10.000 day being exploited by a state actor a single manageable setback shows
A, a dangerous level of complacency. Reputational damage isn't just about the immediate stock price, it's about long-term trust, especially with the federal sector, where Cisco holds critical infrastructure positions. If the $3 billion AI pipeline is driven by the network fabric, and that fabric is shown to be fundamentally exploitable at the highest level, then the due diligence teams in the hyperscalers and government agencies are going to be forced to scrutinize alternatives. It could delay or even reduce future orders. That reputational discount being applied to the stock is completely rational.
And that brings us back to capital flow, specifically the role of retail investors, which I believe is significantly underanalyzed here. The dominant structurally bearish sentiment among retail, the whole boomer stock classification, the plumbing versus brains fallacy, it's rooted in some pretty profound behavioral biases. Retail investors, they anchor themselves to the Nvidias of the world, and they neglect the value in mature infrastructure giants. It's a classic case of survivor bias. They are, frankly, unsophisticated in their view of high-performance Ethernet fabrics and the structural shift that's driving this AI pipeline. They just don't see the value.
That's a compelling point about behavioral biases, but the sophistication of the retail view is almost secondary to its real-world consequence. The fact is, the widespread dismissal of CSCO means the stock is fundamentally devoid of the high-velocity momentum capital you need to sustain a breakout above that $80 ceiling. And institutional traders know this. They know that without a significant retail or momentum bid, the stock's energy is just capped, and that transforms the $80 level from just resistance into a structural ceiling. And we can confirm this by looking at how the stock is used even by its supportive retail niche. Even the bullish retail group, the Theta Gang, they view CSCO only as an income vehicle. They're all about selling covered calls to harvest premium, not aggressively buying calls to bet on appreciation. That activity confirms a consensus shared by retail income investors and institutional distributors that the stock is range-bound. When your call option open interest is dominated by sellers, it just reinforces the institutional belief that the upside is capped, and it validates the $80 ceiling.
The lack of high-velocity retail interest just means the stock trades on proven fundamentals and institutional rotations, which is precisely why that $3 billion AI order pipeline is the single most critical piece of evidence. You cannot deny the economic reality of a pipeline that large. It fundamentally re-rates the company's long-term earnings, regardless of whether a few retail groups are selling covered calls or whether dark pool shorting is momentarily elevated. That $80.25 high was a necessary test of long-term resistance, and it was driven by real economic data. Temporary technical selling, whether it's algorithmic or discretionary, is just obscuring the long-term truth of the structural growth narrative.
And I maintain that technical selling was not temporary. It was a sophisticated, planned distribution. The fact that the highest dark pool short volume ratio, 54.76%, happened on the very day of the peak price means that for that crucial moment, every single dollar of fundamental bullish conviction was met with a dollar of planned institutional liquidity withdrawal. The sharp retracement afterwards infirms that the liquidity it dried up, leaving the late buyers trapped. We have the microstructure data to prove the ceiling holds, and that ceiling is reinforced by the very real critical security risk from the CVSS 10.0 vulnerability that challenges their core business integrity.
So, to summarize my position, the fundamental case that $3 billion AI pipeline is the strongest, most verifiable evidence of a successful and enduring structural pivot. I think investors should look past the short-term microstructure noise, the institutional hedging, and the behavioral biases of retail, and focus instead on the validated structural growth and the historical financial resilience that validates the company's long-term value.
And I maintain that the $80.25 high was executed as a classic bull trap. The smart money used the AI catalyst as perfect cover to sell. It's evidenced explicitly by that 54.76% off-exchange short volume right at the peak. And that, coupled with the critical zero-day vulnerability undermining their entire security thesis, it fundamentally justifies skepticism. For now, the ceiling holds, and the risk outweighs the reward.
So the debate really leaves the discerning investor with a compelling choice, either to trust the concrete, forward-looking financial pipeline data and the successful tech pivot into AI fabrics,
or to trust the immediate, critical microstructure signals, the peak dark pool distribution, and the very real execution risks that come with the CVS 10.0 Aquashell thread, which is confirmed by insider selling.
The material requires continued rigorous monitoring of both the execution of that security fix, which is vital, and the capital flow dynamics, particularly inside the dark pools. The tension between the AI validation and this deliberate institutional distribution is what defines CSCO at this $80 threshold.
Absolutely. That tension is the entire story. The $3 billion AI validation battling against the $80.25 high, which coincided perfectly with peak dark pool distribution and the very real material impact of that Aquashell 0-day.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.